Transfer pricing refers to the pricing of goods and services between related parties, such as a parent company and its subsidiaries, in different countries. It is an important issue for tax authorities, as related parties may manipulate transfer prices to reduce their tax liability in a particular country. To combat this, tax authorities have developed transfer pricing regulations that aim to ensure that related parties conduct transactions at arm's length, meaning that the prices are similar to those that would be charged between unrelated parties. In Nigeria, transfer pricing is regulated by the Income Tax, Transfer Pricing, Regulations, 2018, TP Regulations, made under the Federal Inland Revenue Service, Establishment, Act, 2007. These regulations are to be applied consistently with the OECD Transfer Pricing Guidelines for Multinational Enterprises and Tax Administration's 2017 OECD TP Guidelines and the UN's Practical Manual on Transfer Pricing for Developing Countries 2017 UN Manual, as may be supplemented and updated from time to time. There have been some recent developments in transfer pricing regulations in Nigeria, including the introduction of a seventh schedule to the Companies Income Tax Act under the Finance Act 2019, which contains various tax changes with effect from January 13, 2020. The introduction of this schedule limits the tax deductibility of related party transactions, specifically interest expenses incurred by Nigerian companies or fixed bases of foreign companies in Nigeria that have borrowed from foreign connected persons. The deduction allowed under Section 24A of Companies Income Tax Act, CITA, is now restricted to only 30% of the company's earnings before interest, tax, depreciation, and amortization, EBITDA. The interest deductibility rule in the 7th Schedule to Companies Income Tax Act, CITA, complements and does not replace the transfer pricing rule. Therefore, taxpayers must ensure that interest expenses comply with the Income Tax, Transfer Pricing, Regulations 2018 before applying the interest deductibility rule. Additionally, the Federal Inland Revenue Service, FIRS, launched an electronic transfer pricing, TP, filing portal called ETP Plat 2.0 in March 2020. This electronic filing solution allows companies with TP and country-by-country reporting, CBCR, obligations to file their annual TP and CBCR returns electronically. The platform allows taxpayers to complete and submit the TP declaration and disclosure forms, country-by-country notification forms, and country-by-country report online. This electronic filing platform helps ease the compliance burden on taxpayers and allows the FIRS better to monitor compliance and analyze the data provided by taxpayers in their returns. Furthermore, the FIRS intensified its efforts toward driving TP compliance through the conduct of TP audit exercises by rolling out letters requesting the submission of TP documentation and other supporting documents to several taxpayers. Transfer pricing audit primarily focuses on reviewing transfer pricing returns and supporting TP documentation submitted by taxpayers who had engaged in related party transactions. This approach is necessary for the tax authority to independently confirm the arm's-length nature of the related party transactions as documented in the TP reports and to arrive at an appropriate TP adjustment, if any. In a situation where the related party transactions do not comply with the arm's-length principle, the TP regulations empower the tax authority to make necessary adjustments to the arm's-length price, and this may result in additional tax liability to the affected taxpayer. In 2015, the Federal Inland Revenue Service, FIRS, of Nigeria began conducting transfer pricing audits, which focused on the arm's-length pricing of transactions between related parties. One of the cases that emerged from this process was Prime Plastic Hem Nigeria Limited, PPNL, versus Federal Inland Revenue Service, FIRS. The case centered around PPNL's purchase of plastics and petrochemicals from a foreign related party supplier, Vinmar Overseas Limited, in 2013 and 2014. In 2013, PPNL used the comparable uncontrolled pricing, CUP, method to determine the arm's-length price, while in 2014, it used the transactional net margin method, TNMM, with the operating/net profit margin as the profit level indicator, PLI. PPNL filed the relevant transfer pricing documentation for both years with the FERS, and the tax authority subsequently requested additional documentation. After reviewing the information provided, the Federal Inland Revenue Service, FERS, served Prime Plastic Hem Nigeria Limited, PPNL, additional assessment totaling over 1.7 billion naira, inclusive of interest and penalties. PPNL filed an appeal at the Tax Appeal Tribunal, TAT, which was tasked with deciding whether the FERS was correct in rejecting PPNL's use of the CUP method for 2013 and whether the FERS was correct in using the gross profit margin, GPM, method as the PLI for 2014. The Tax Appeal Tribunal, TAT, ultimately held that Prime Plastic Hem Nigeria Limited, PPNL, had the onus of providing sufficient information to the tax authority to validate the use of any transfer pricing methods. This was in accordance with Regulation 5.2 of the 2012 Regulations and OECD TP Guidelines, which stipulate that the availability of reliable information is a necessary condition for a transfer pricing method to be considered most appropriate. Therefore, the FERS's rejection of the CUP method was deemed to be in line with the provisions of the regulations and guidelines. The Tax Appeal Tribunal, TAT, also noted that the choice of the most appropriate profit level indicator, PLI, should consider the respective strengths and weaknesses of the various possible indicators and the nature of the controlled transaction in question. In this case, the FERS was correct in using the gross profit margin, GPM, method as the PLI for 2014, as it had considered the various factors enumerated by the OECD guidelines in deciding that this was the most appropriate method to use. Overall, the case of PPNL v. FERS highlights the importance of providing sufficient information to tax authorities when using transfer pricing methods and the need to consider the various factors when choosing an appropriate PLI. The Tax Appeal Tribunal, TAT, upheld the Federal Inland Revenue Service's, FERS, decision to reject Prime Plastic Hem Nigeria Limited's, PPNL, use of the comparable uncontrolled pricing, CUP, method and to use the gross profit margin, GPM, method as the profit level indicator, PLI, for 2014. It is crucial for individuals to seek professional guidance from tax experts to receive personalized advice relevant to their unique circumstances. This statement serves as a disclaimer to remind the audience that the information presented should not be taken as official advice. Instead, it is a general overview of a topic from the perspective of Olatunji Abdulrazak, and it is up to the audience to interpret and use the information accordingly. Thank you.